Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. This is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any mentions of rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal or tax advisor to be sure a Roth IRA conversion fits into your planning strategies. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.
Coming up today, we explore the best way to clarify your retirement savings strategy, discuss tax tips and new legislation regarding that might change the world of Social Security as we know it. All that and more coming up next.
And now, how to retire with Fuchs Financial.
The main thing for the majority of the listeners out there who are approaching retirement is I don't want to be surprised.
Helping you build, preserve, and manage your wealth.
You got Roth IRAs, you have individual accounts, and finding the right taxable strategy, that's going to be huge for you.
Welcome in to How to Retire with Ben Fuchs.
Money can't buy happiness, but it can buy you a yacht big enough to pull right alongside it, according to David Lee Roth. And it's funny because we're going to talk about Roth. By the way, David Lee Roth, no relation to the senator from Delaware whose namesake is Roth. So we're going to talk about this in just a moment. But first, let's welcome Ben Fuchs in. Ben is here, and Ben is here to take charge of your money. He's a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience in the business. Ben, how you doing today?
Doing all right, Gary. How are you, my friend?
All right. Did you like that quote from David Lee Roth?
I did. And, you can't argue with facts, right?
Right, exactly. I love that. So anyway, we're going to talk about a choice between a Roth and a Roth 401k with nothing to do with Dave Lee. Now, it can be trickier than you might think. So today, we're going to walk through a few steps to help you clarify the best path for you as you save for retirement. So we've got a bunch of different steps to go through. So we'll start off with a question. Why do people think they're excluded from contributions if they make more than a certain amount of money? And our first question is, do you expect to be a higher or lower tax bracket in retirement, Ben?
Yeah, I mean, it's interesting. So, going back to that question, that higher or lower tax bracket. So, the main clarifier there with a Roth 401k versus a Roth IRA is that with a Roth IRA, there are income limits. They exclude you from being able to generate to contribute. With a Roth 401k, there are no limits. And you say, Ben, that doesn't make a lot of sense. Why do they do it that way? And my answer is, I have no idea. It doesn't make sense to me either.
Not from the government. You're not from the government.
Right. I can understand what the rules are and then play the game accordingly. However, I am not the one making the rules. So, when it comes to consider both current and future tax brackets, do you expect to be, as Gary said, in a higher or lower tax bracket in retirement? This is really important because a lot of people, one, don't really know the answer, and two, they may expect to be in a lower tax bracket and find out that they're going to be in a higher tax bracket regardless of what they spend or what they want to spend either way because of things like required minimum distributions and other things that we talk about here on the show. So if you're going to be in a higher tax bracket in retirement, obviously we want to be putting as much money now and paying the taxes now up front. If we expect to be in a much lower tax environment, which is the case with a lot of my clients also, then we don't want to just start contributing all into that Roth portion of the 401k or IRA. I think what we find, and Gary, tell me if it's different for you, but what I find is that a lot of people will hear about these Roth IRAs, the Roth 401ks, hear all the benefits of them, and then say all of a sudden, I want everything to go there from now on. I don't want to put anything in the traditional.
Right. I hear that a lot.
Right. And so what we found through different clients is that the people that do that could also be hurting themselves. And so that's the reason why we offer these free consultations to people, so they can come in and just get a checkup. We don't want you to, no disrespect, we don't want you to make crazy changes to your retirement plan based on, words that we're broadcasting to thousands of people at once. We want you to figure out what it's going to help you in your individual situation.
Mm-hmm. And again, we talk about this in prior shows. Every situation is different. Everybody is unique when it comes to retirement planning. That's why you need to get the How to Retire Blueprint. Should have told you right at the top of the show. Here's that phone number, 800-380-8985. Ben's going to put it all together for you. You walk away from the conversation with clarity and understanding exactly where you are. How to Retire Blueprint, 800-380-8985. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. The thing, Ben, this is so confusing to a lot of people. So let's keep going. Consider how much longer you have until retirement, how much longer you will be investing. Let's talk about step 2 now.
Yeah, so step 2, this is critical because, and it's different. People will say, oh, it's just based on your age. And it's not really. I've got clients that have retired at 55 and clients that have retired at 75. And so, there are different goals. But if you're a 55-year-old that's planning to work for another 20 years till 75, almost all the time, not all the time, but I would say 98, 99% of the time, we want to be putting money into that Roth. Because again, the money that you put there, that if it can sit for 20 years, should double twice. So let's say that you're a great saver, you're 55 years old, you can put $30,000 into that Roth IRA. Well, again, if we're doubling twice, it's going to go from 30 to 60,000, and then from 60 to 120,000, right? Mm-hmm. And that means we only paid the taxes on that original 30 and not on that 90. Now, we take it back a step. We started doing that at 45 instead of at 55. That 120,000 now becomes 240,000. So again, you only paid the taxes on that original 30,000 and not on the $210,000 of gains.
Yeah.
So the earlier that you're able to contribute to that Roth IRA, the better. The longer time frame that you're going to have for that money is going to be invested, way more likely to want to be putting into the Roth IRA or Roth 401k. On the same token, if we're 3 to 5 years away from retirement and we're earning more money than we ever have in our lives, and you know who you are, that's when you want to get the tax deduction, right? Hey, I'm in the 32% tax bracket. I'm only going to be in the 12% tax bracket when I retire. Let me get the tax deduction now, and then I can take that money out at 12% a couple years. Mm-hmm. But again, it's scenario-based planning. Again, we're talking to a wide audience. We need to figure out what makes sense for you. That's why we have our team of advisors that can meet with you and sit down and give you a complimentary consultation so that we can go through your scenario and figure out how we can help you.
Yeah, no question about it. By the way, I'm going to, a couple of weeks ago, AT&T had that issue, right? And you know what they did? I found in my account, they gave me a $5 credit. So I'm going to put that $5 credit in my Roth account. That's exactly, and I'll watch it grow, Ben, because that's a big deal.
I like that, Gary. Just as a clarifying, because I don't want to get in trouble by compliance, just as a clarifying mention, because you are still working and earning income, you can do that. But if you are already retired, and
Yes,
I don't believe AT&T or anybody considers that earned income. So
no, probably not.
If you can't do it if you're retired, just throw it out there so that I don't get in trouble. Thank you,
All right,
Gary.
thanks, man. I'm glad to help. I'm happy to help out in any way I can. You know that. That's what I do on the show here. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Let's get you the phone number, the How to Retire Blueprint. That's what you need. 800-380-8985. 800-380-8985. $5 credit. Come on, AT&T.
Thanks, AT&T. Way to really go for it.
Exactly. Yeah, way to go.
You know what we like to talk about? Reliability.
Yeah, so, exactly. Okay, step 3. The goalposts can move at any time. There are changes that are made in the way of tax policies often and not always clear how, when, what, who, and why the amendments are made and if they will impact you. Clarifying question number 1 here on step 3. Will taxes be higher and lower in your future? Well, what do you think about that, Mr. Fuchs?
All right. So the technical answer is that the changes from the Tax Cuts and Jobs Act of 2017 are scheduled to sunset, meaning expire in 2026. So
yes,
including the lower tax brackets and the higher standard deduction. So for a lot of people, that has meant that they want to be doing Roth conversions over the last couple of years while they're in that lower tax bracket. With that said, we have no idea what the policy is going to be in the future, depending on who gets elected and who are the people surrounding that person that will get elected. It obviously change a lot of things. My job isn't necessarily to predict the future, it's to prepare you for whatever happens. So yes, in these scenarios, when it makes sense to you, we absolutely want to convert as much as we can in a comfortable way. But if you have $1 million in your 401k, we just don't want to convert that whole thing into a Roth IRA at once. You'll still be pushing yourself to the highest tax bracket. It doesn't matter what the standard deduction is. You only got that once, and you're still paying 37% for federal taxes and maybe 5, 6, 7% for state taxes, depending on where you are. So a significant amount of taxes if you don't do this correctly. So again, yes, there are potholes and things that we have to watch out for, pitfalls, but ultimately it's our job to navigate you through those.
Yeah, I mean, most people would think that taxes are going to be higher in the future. I don't know anybody thinks it's going to be lower, as far as I know. And
I never hear anybody.
A bridge for sale in Brooklyn for you.
Is that an outside? You could sell the Brooklyn Bridge. I thought it was never mind. Yeah. Beachfront property in Arizona. Exactly. I would go for it. But
you got that too.
And, I mean, what was that statistic that came out a couple weeks ago that for the first time in our history we're paying more in interest on our debt than we are on defense spending?
Yeah.
And say, we can't, that is not a sustainable option. The solution to that is, cutting and more revenue, but where are we going to cut from? So, let me not get political. That is the fine line that we have to walk here. But, take a look at what's coming and prepare.
Yeah, be prepared for it. And that's why you need Ben. That's why you need the How to Retire Blueprint. 800-380-8985. 800-380-8985. Folks at Fuchs Financial are standing by, ready to take care of you, get you on the calendar, get yourself all set with a comprehensive plan, no cost or no obligation. Claim your spot on Ben's calendar. 800-380-8985. All right, number 4, remember, it's not what you make, it's what you keep. So are you being tax efficient to optimize the performance of your portfolio, Ben?
Right. So this is like, oh, man, if I have to hear that line one more time about not how much you make, how much you keep, I might go crazy. And look, I'll be perfectly honest, I feel the same way. However, it is relevant because if you don't understand how Social Security is taxed, you're going to end up paying too much. If you don't understand how dividends and capital gains are taxed outside of your IRA or 401k, you're at risk of paying too much. For us, it is looking at every piece and make sure that everything is as efficient as it can be. And if the worst thing that happens is that you come in for an appointment with one of our advisors and they say, hey, you're in great shape, at least you've got some peace of mind. And we're happy to give you that. And we obviously don't charge for that peace of mind. Although, maybe we should, Gary. We'll change our business model. But, the whole reason that we do this, the whole reason that we have a How to Retire Blueprint is so that we can help people figure out, all right, when should you take Social Security? Where do you generate your income in retirement? When you no longer have a paycheck, how do you generate that paycheck from your investments in a consistent and predictable way so you don't have to worry about it? Are your investments in the right place? Are they tax efficient? And when you die, will your money go to where you want it to be? And then not just creating a plan, and not just setting up a plan, but also the continuous monitoring of that plan. We understand that things change all the time. Maybe you have children that have moved back into your house. Maybe you have parents that have moved back into your house. Maybe it's both at the same time, and God bless you. But we understand that these things will happen, and we want to be there to help you every step of the way to make sure that you have a fun and secure retirement. Because honestly, our goal is to take the weight of money management off of your shoulders so that you can focus on all the other important things that life has to offer.
All right, Ben, great advice. Your chance to benefit from the How to Retire Blueprint. Call right now. We still have a limited number of availabilities on our calendar this week. And remember, the consultation is offered at no cost or no obligation. It's a fun segment we just went through. 800-380-8985. 800-380-8985. Get the How to Retire Blueprint. Do it right now while you're thinking about it. Folks at Fuchs Financial are standing by. And Ben, thank you for reminding me that my grandchildren live with me. I appreciate that greatly.
Anytime, Gary. I'm here for you, buddy.
I'm sure. All right. Well, we're going to take a quick break. Be back with more of Ben and How to Retire in just a moment. What's up next, sir?
All right, we have 4 practical strategies to help you with taxes and dive into the particulars of a bill that, if passed, has the potential to change the landscape of Social Security as we know it. Coming up in 60 seconds.
He's letting the clock run out on his Social Security to age 70 for maximum benefits. And here comes the Roth conversion. He's locked in for income for life. He's got some outstanding coaching with that annuity plan. He's created his own pension as well. And it looks like he's going to go all the way.
Play your best retirement game. Call Ben Fuchs at Fuchs Financial, 800-380-8985, 800-380-8985.
There's one for you, 19 for me, because I'm the tax man. Famous line from the Beatles song called The Tax Man. And we're going to talk about taxes in this particular segment. When considering tax-efficient ways to save for retirement, might be worried about how to apply these options to qualified accounts that you've been saving in retirement thus far. We'll get to that in just a moment. But first, to remind you, the show is How to Retire with Ben Fuchs. I'd like to welcome Ben back in. Ben is a certified financial planner, certified private wealth advisor, professional, and fiduciary. Has over 20 years experience in the retirement business with Fuchs Financial. Ben, so let's talk about this. Understanding a few tax planning benefits and how they apply to your retirement planning journey by the numbers. We got some number crunch. I didn't know there'd be math today.
Yeah, I know at a financial show, I hate it when there's math too.
I hate it when they throw math out there. Yeah.
But we're going to give you some pure bullet point numbers here. So first bullet point here, $8.9 trillion in employer-sponsored defined contribution plans. So defined contributions, those are your 401ks, your 403bs, your thrift savings plans, your 557s. If I missed one, I'm sorry. But that's what those are. Overall, 85% of these defined contribution owning individuals agree that the tax treatment of my retirement plan is a big incentive to contribute. This is according to American Views on Defined Contribution Plan Saving from the Investment Company Institute. Also, agreement was high across all age and income groups, although it tended to increase with age and household income. Additionally, a very large majority, 88%, disagreed that the tax incentives of defined contribution plans should be removed, and $6.3 trillion are held in 401k plans.
Wow.
So what do we do with all these numbers? I think what's important is that if we say there's 6.3 trillion just in 401k and 8.9 trillion overall in employer-sponsored plans, that means that there is a lot of money that will be taxed as it is removed. So when we look at that, we understand that we have to navigate that carefully. We have to do that efficiently, and we have to do that patiently. I think, one of the concerns is that they can change laws and change. We can't control what we can't control. We just can't. We don't have any control over that. I don't have control if the government changes Social Security, but I can plan for it. I can make sure that I've saved more so that I don't have to rely on that income as much, so that I'm ahead of the game. And if they change the rules on taxes, I can plan ahead for that. Then we can look at different tax saving strategies about doing certain Roth conversions when they're appropriate. The whole idea here is to understand the numbers to predict what could happen and to plan for what will.
Mm-hmm. But the thing is, we have to always prepare for things that we don't know. And like you said, you don't make these decisions. So that's why, Ben and his team, they're going to work with you to find out the best way to save on taxes and minimize those tax problems that you might be having. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Get the How to Retire Blueprint, 800-380-8985, 800-380-8985. We have tax-efficient planning options. There's like 4 different ones here, Ben. Why don't you run through these for us?
Yeah, so obviously contributing to a Roth IRA or Roth 401k is one of the most efficient things and one of the best things that you can do, and then obviously that you should recommend that your children do when they become of age. Roth conversions where appropriate. Again, that means that we're paying the taxes on money that we haven't paid taxes on yet. So if I've got, $1 million in a 401k and I want to convert some of that to a Roth IRA, I can do that, but not all at once. I might take $20,000, $50,000, $100,000, maybe even $200,000 where appropriate. Pay the taxes on that up front and get that into the Roth IRA so that I can never have to pay taxes on it ever again. So that's what we're looking at there. There's backdoor conversions for people that make too much money. There are certain kind of loophole. They call it a backdoor Roth IRA. I'm going to stay out of that for now. And then also living benefit plans. So this is one that we've seen for a long time. They look at tax code 7702. Think life insurance. And don't get me wrong, for my clients that are in their 60s, it is not something that I would say is a strong recommendation. But for people who are younger, that are making a fair amount of money, this is something that makes a fair amount of sense. So Section 7702 of the tax code differentiates between income from a genuine insurance product and income from an investment vehicle. Certain types of permanent life insurance build up a cash value over time. The proceeds of a contract that does not meet the IRS definition are taxed as ordinary income. An insurance policy that fails these Section 7702 criteria becomes a modified endowment account and permanently loses its tax advantage status. Now, what does any of that mean? Great question. Thank you for asking.
Yeah, I was just about to ask because I'm confused, Ben.
Right. So what you can do is that for a lot of people that are building up a lot of cash value inside of their whole life insurance plan, universal life insurance, universal index life insurance plan, instead of taking a withdrawal from that, you might take a loan from that policy. Just like you might take a loan from your house, a home equity line of credit.
Okay, got it so far.
Right. So if you sell your house and you take the proceeds, you pay taxes on the gain if it's over a certain amount, right? If you sell it. But on home equity line of credit, you can do that line of credit and you don't pay taxes on that loan. Same concept when it comes to life insurance. You can take these loans from the life insurance and when they're appropriate, use that as income as long as you're playing within the rules. And don't get me wrong, the rules are very specific. But there are certain circumstances where it does make sense for people to overfund this life insurance and use that as income. In most instances, and this isn't to be selective or anything like that, when I would recommend that to somebody is when they're very, very high income earners. When they've already maxed out all of the other options that they have, they've maxed out their 401k, they've got their safety net, every other kind of duck is in a row. And when we have that, then we say, all right, we can save a lot more money in taxes if we do this based on this earning potential. So it's an option that a lot of people should look into if they're higher income earners in their 30s and 40s.
Yeah, I'll bet you, Ben, a lot of people aren't aware of this, and that's why they need to come see you and the team at Fuchs Financial, and whatever analogy you like to use. There's too many moving parts, too many puzzle pieces. It becomes very difficult to do this yourself, and that's why you want Ben in your corner. We want you to get the How to Retire Blueprint. It's a comprehensive plan. There's no cost or no obligation for it. Folks at Fuchs Financial are standing by 800-380-8985. Maybe you have a question or two what we're talking about. Maybe it's kind of confusing and we didn't explain it as well as we could on the show due to time constraints. 800-380-8985. Get the How to Retire Blueprint. Do it right now while you're thinking about it. Okay, so in the headlines right now, there's something called You Earned It, You Keep It Act, which is House Bill 7804. What is this? Have you heard about this, Ben? I'm not familiar with this at all.
A little bit. So this seeks to enhance American seniors' financial stability while contributing to the nation's fiscal health. The You Earned It, You Keep It Act, first introduced in 2022 and reintroduced in late January 2024, proposes eliminating all federal taxes on Social Security benefits starting in 2025, a move designed to significantly increase retirees' disposable income. The bill would be paid for by raising the cap on the Social Security payroll tax so higher-earning Americans, individuals earning more than $250,000 a year, continue paying into Social Security. This move could extend the solvency of Social Security payments to 2054, 20 years longer than current projections, and estimates say it would also reduce the federal debt by $8.9 trillion over 75 years. Or will it? So here's my thing with Social Security. I don't understand why it's taxed to begin with. Now, granted, I'm not a policy holder, but Social Security itself was all a tax. Right, 6.2% of your income up to certain limits. Right now it's like $160,000 and change, and every year that goes up a little bit. But, I don't understand personally why somebody making $170,000 and somebody making $1 million is contributing the same amount to Social Security every year. Don't get me wrong. Like, I get it. They probably get mad at me. Ben, be quiet. We like our tax break. I hear you. At the same time, that doesn't make a lot of sense to me. We can just make that change very simply by raising the limit of what is contributed. There's no reason to cap it off at a certain value, especially when we have these solvency issues. Again, you have people at the lower end of the spectrum that are contributing more. So it's a concern. But the tax itself makes no sense because it was already all taxed money. Right, this was already money that you've already paid into. Now when you take it back, you're getting taxed again. I don't like that. So it has always been somewhat of a big issue for me. With that said, can't really control it. To have it go forward and to have it not be taxed makes sense. And in order to do that, to effectively raise the tax on people making over a certain amount of money, but really just include them in the taxes that everybody else is paying, seems relatively fair for me. And I haven't heard a good argument against it.
Mm-hmm. No, it seems fair to me, too. And, also, you earn that income throughout your years of money going into Social Security, so you paid taxes on it once already. Am I right, Ben?
Absolutely. I mean, you've already paid tax on it. Just like a Roth IRA. You've already paid the taxes on that money and you put that money away. Why are you paying the taxes again when you take it back out? That makes no sense to me. It's not a logical conclusion. Now, I think that first changed in 1986 and then it changed again in 1996. So I think it was 1986 when they first first instituted that 50% tax on Social Security, and I believe it was 96 when they raised it up to 85%. But look, and also those limits, for whatever reason, have not been changed by the cost of living adjustment. Right? Everything else is going up with cost of living, but how much you're taxed on Social Security is not, which means more and more of that income is becoming taxed.
You know, Ben, we're going to talk about Social Security in the third segment here, too, the complete segment of Social Security. We'll get to that coming up. So anyway, final thoughts on this segment and going forward here before we take our break.
Yeah, I think the reality is that there's a lot of uncertainty regarding Social Security. There's a lot of concern, and there shouldn't be, but there is. And the best thing that we can do is to help you prepare for what could happen. And for us, that's what we're here for. We're here to prepare for the unknowns, to make sure that you have a plan in case, hey, if there's no more Social Security, how will you be comfortable? Now, I don't think that'll happen, but if it does, let's plan for it. But ultimately, we've talked about taxes the last two segments. Is your money being taxed efficiently? Will you be in a lower tax bracket in retirement? Will you end up having to pay more in retirement? Let's figure that out so we can plan now. Your investments. Will a stock market correction, will a drop of 20 or 30% affect your ability to live in retirement? If it will, let's make some changes. Ultimately, our goal is to help put you in the best position for retirement, and we do that through scenario-based investing, through scenario-based situations. We'll look at your scenario and we'll say, okay, how would it react if the market crashed? How would it react if taxes are raised? What can we do ahead of time to prepare? Those are all wonderful things that our advisors can help you with, but we can't do any of that unless you pick up the phone and give us a call.
All right, Ben. Great advice as always, and a great segment. We're going to follow it up with Social Security in just a second here. 800-380-8985, 800-380-8985. Folks at Fuchs Financial is standing by. Claim your spot on the calendar right now. Your chance to benefit from the How to Retire Blueprint. Call right now. We still have a limited number of availabilities on our calendar this week. And remember, the consultation is offered at no cost or no obligation. So what are you waiting for? You've been listening to the show every week. We certainly do appreciate that. But now it is time to take action and dial those numbers. 800-380-8985. Do it now. We're going to take a quick break. Be back with more of Ben and How to Retire in just a moment. What's up next, my friend?
Sometimes it's necessary to reflect on our past to fully understand what the future may hold. When we come back, we discuss the evolution of Social Security and the changes you need to know about.
We believe in better. A better way to invest. A better way to serve you. And a better result. We can help you determine how much risk you're taking, red flags that could be potential problems for you, how much you are paying in fees or commissions, potential tax liability, or even how to address Social Security. Call Ben Fuchs at Fuchs Financial, proudly serving all of Connecticut. Call today, 800-380-8985. 800-380-8985.
Welcome back to the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. And back with us to help you take charge of your money is Ben Fuchs. Ben is a certified financial planner, certified private wealth advisor, professional, and fiduciary. And has over 20 years experience in the retirement planning business. Of course, very important distinction when you're looking for a financial advisor, because by law, have to have the best interest of their clients. So we'll talk about Social Security and give a little history lesson here. And it was created in 1935, began paying out monthly benefits to workers 5 years later. The good news, it's still doing just that today and will continue to do so for the foreseeable future, according to our show notes. We certainly hope that's true. So let's talk, first of all, Ben, let's dig into the history books here. What is the Social Security Act?
All right. Get ready, people. Hopefully you have your pens and paper. There will be quizzes at the end.
I thought there'd be a quiz on this.
Get excited. All right.
Yeah, exactly.
So on August 14th, 1935, President Franklin D. Roosevelt signed the Social Security Act, creating a program for monthly benefits to retired workers aged 65 or older. The legislation introduced a payroll tax to fund the program, mandating employers to withhold the tax from employee wages. Keep in mind that in 1935, the average life expectancy was 61.
Oh, again, not good. So, yeah, hold on.
Couldn't get it till 60. Right. So if you live a really long time, congratulations, here's your benefit. Regular monthly payments to retirees began in 1940 with the first check issued to Ida Mae Fuller of Ludlow, Vermont. totaling $22.54 in January of 1940.
Wow, that's amazing. A lot of money there.
Not bad, yeah.
Not bad.
Well, I mean, I think she only contributed like $3 in. So the first check was more, I think she got it right anyway. But, monthly payments continued, reaching an average of $1,464 a month back in January of 2019. So obviously, it's a program that was developed to take care of people. If you ever see on your paycheck, OASDI, Old Age Survivors and Disability Insurance. That's what that is. It literally says old age. And now, somebody that's 65, we would never consider to be old. It's become a new dynamic. And of course, my grandmother of blessed memory passed at 102 in September of last year. And, lived a long, full life, still able to live on her own for a long time.
Yeah.
This is kind of somewhat of a new normal. More and more clients have parents in their 90s and 95, so obviously we want more, but that does affect Social Security when the average lifespan is a little longer than 61 today.
Yeah, and that's thereby the shortage in Social Security because people are living a lot longer, drawing on Social Security for, 20, 30 years, maybe longer. When it was first designed, like if you got to 65, you were lucky. It was like who knows, Anyway, so why was Social Security created, Ben? Let's talk about why.
Social Security originated during the Great Depression, addressing widespread unemployment and poverty among the elderly.
Mm-hmm. Yeah, absolutely. And it definitely was needed at that time. And the government had the foresight to do something to try to help people in their senior years. So now, when did the spousal and child payments begin? When did that happen?
So amendments in 1939 introduced payments for the spouse and minor children of retired workers and benefits for survivors of prematurely deceased workers. Spouses can receive up to 50% of the higher earner's benefit. So, they've continued to make amendments to make it easier for people. And obviously, somebody passes away, they don't want them to be destitute.
Mm-hmm. So the show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Thank you for joining us, spending part of your weekend with us. We certainly do appreciate that. We're talking about Social Security. Get to it in just a second. But I do want to remind everybody, you really need the How to Retire Blueprint, 800-380-8985. There's a lot of different aspects of Social Security. We're going to go through here in the show as many as we can, but you need to get a hold of Ben, and that's a vital part of your retirement. 800-380-8985. Get the How to Retire Blueprint. Again, the show is How to Retire with Ben Fuchs. All right, let's keep going through our history lesson here. So has Social Security retirement age changed? I know it has. Tell our listeners.
I'll be delighted. So initially it was set at 65, as we talked about earlier. The retirement law changed in 1961, allowing workers to claim reduced payments as early as 62. And then a 1983 law raised the full retirement age to 66 for most baby boomers, and then 67 for those born in 1960 or later. Mm-hmm. So over time, as we continue to live longer, what they would consider the full retirement age has changed. But keep in mind, the full retirement age is just the amount that you can collect and still continue to work. It's not like you must wait until 67 or must not retire until you're 67.
Right.
You can retire at 63 and collect Social Security. You're just going to get less.
Right. Yeah, we talked about that before. Yeah, you can anywhere from 62 to 70, you can collect Social Security, and basically the longer you wait, the more you're going to make. If you wait till 70, you're going to get about 132% of your benefit. Increases roughly about 8% every year. So here's something that a lot of people didn't know, that at one point Social Security wasn't taxable, and then it became taxable, didn't it?
Right. So from 1984, part of Social Security benefits became taxable for individuals earning above a certain threshold. If income exceeds $25,000 for individuals or $32,000 for couples, up to 50% of Social Security benefits can be taxed. So this is kind of a little bit misleading. So there's a formula. The formula is called the provisional income formula. If half of your Social Security plus all of your other income. So let's say you're getting $30,000 a year from Social Security, and you've got $8,000 other dollars coming in from your IRA. You're making $38,000 a year. In that scenario, half of your Social Security, $15,000, is added to the 8, so a total of $23,000. That's under the $25,000, which means congratulations. I hope you like a lot of numbers as you're driving somewhere. Hopefully you're not trying to write these down. I apologize. But in that scenario with $30,000 of Social Security and $8,000 of other income, you're not being taxed at all on the Social Security. And if that's your total income, again, that $8,000 from the IRA that is taxable is still less than your standard deduction. Mm-hmm. So in that scenario, nothing will be taxable federal. And depending on the state, nothing should be taxable in the state either, even in Connecticut. So that's a scenario where, that formula is going to help you. And that's, again, when you come in for an appointment, we'll go through your scenario to help you figure out your provisional income formula so that we can help you with that math.
All right. So at what point, originally from what I read, Ben, it was 1% contributions from Social Security taxes. That's changed over the years too. That's increased quite a bit, hasn't it?
Yeah. So, the 1% contribution rate was in 1935 and increased to 6.2% in 1990. And the tax cap rose to $132,900 in 2019, exempting earnings beyond this amount from the payroll tax. Now, that goes up every year. Obviously, we're a little past 2019. This year, it's a little above $160,000. So the amount that you basically cap out your earnings at, and again, what we talked about in the previous segment, where something they were thinking about doing away with was that limit, right? If you made, back to 2019, you made $133,000, $132,900 was taxed for Social Security. Above that was not. So somebody making $133,000 in 2019 and somebody making $1 million in 2019 paid the exact same amount into Social Security. What this new law is proposing is, let's not do that cap. Why don't we just have the $1 million person pay their Social Security taxes also? Which, by the way, I'm kind of okay with. Not that I'm a fan of raising taxes, but I'm also a fan of Social Security solvency. And let's face it, selfish self-interest. A lot of my clients rely on Social Security. I don't want that to go away.
Yeah. And, we hear these numbers tossed around anywhere from 40 to 60% of your income is, Social Security throughout, throughout your retirement. Some people need it for a lot more, too, which was a whole different issue as well, Ben. But, yeah. So, in fact, I remember, believe it or not, I did have some high earnings earlier in my career. And I remember the last month.
They have no idea how much I'm paying you, Gary.
No idea, yeah. The last month, it was like you get like a raise because Social Security would come out, stopped coming out of your paycheck. So also, because of inflation, they finally got around to giving us a cost of living adjustment. When did that happen?
Right. In 1972, Congress enacted automatic cost of living adjustments based on the annual increase in consumer prices. These adjustments, first implemented in 1975, ranged from 0 in 2010 and 2011, and 2016 to 14.3% in 1980. And of course, we've seen some recent big ones. We had 8.9% a couple years back. We had 8.7%, I think 5.9% year price. We've seen some pretty significant changes, and man, they were needed and certainly did kind of ease up a lot of pressure. Because if you can imagine, in 2024, receiving the same Social Security that you did even in 2019, it'd be very hard for you to live the same lifestyle.
Right, exactly. All right, so the show is How to Retire with Ben Fuchs. Want you to get the How to Retire blueprint. Ben's going to put it all together for you. Get a comprehensive plan, no cost or no obligation. 800-380-8985, the How to Retire blueprint. 800-380-8985. Let's see, a minute or so left, Ben. So payments change over time. I used to go to the mailbox and once a month, and there'd be that green check. It was in green from what I remember.
I'm not sure what a mailbox is.
Yeah, exactly. Yeah,
Is that an Outlook? Is that what that? Okay.
No. It's a real physical mailbox.
That doesn't make any sense.
Not at all.
A real digital mailbox. Got it. Okay.
Exactly. Yeah, there you go.
So look, retirees can now receive Social Security payments online as Security SSA discontinued mailing paper checks. A 2013 law requires beneficiaries to receive payments through direct deposit or prepaid debit cards. While paper statements are no longer mailed, workers can create online accounts to view Social Security statements, check earning statements, with secure and convenient access to estimates for retirement, disability, and survivor's benefits. So this is very important for the people that want to check on their own Social Security. You go to www.ssa.gov, Social Security Administration. That's the ssa.gov. And then you can create your own account. And it takes, 10 to 15 minutes. You have to answer those great questions like, what car did you drive in 1974? But they have all this old tax information. But you need that because it's going to be an important piece of the file. When you come in to meet with us, if you want to talk about Social Security, we want you to do this ahead of time. Bring the statement in so that we can look at it and just use that as one of the many pieces that we have to figure out for your retirement. But again, if you're trying to figure out when you should take Social Security, we can create different scenarios for you so you can see the impact on your retirement. If you want to figure out how your money in your 401k will generate a paycheck for you in retirement, again, we can show you those different scenarios and how we can create that income for you. And then, of course, making sure that a market crash doesn't affect your living, making sure you're taxed efficiently, making sure your money goes where you want it to. These are all things that we do in your How to Retire Blueprint. And then we set up consistent monitoring. Every 6 months, we like to get together so that we can make sure that you're in the right place. And if you have any questions, you really don't have to worry about money anymore in retirement.
Absolutely. 800-380-8985. Great advice from Ben Fuchs. First step, sit down with Ben. Something we talking about resonates with you. To feel need to get the second opinion. Want to make sure your plan is really aligned with your goals. Very important risk tolerance we talk about. 800-380-8985. Get the How to Retire Blueprint. The folks at Fuchs Financial are standing by. Do it right now while you're thinking about it. No cost, no obligation. Claim your spot on Ben's calendar. 800-380-8985. All right, we'll take a short break. Be back with more of How to Retire with Ben Fuchs in just a moment. What's up next, Mr. Ben?
We have some incredible listener questions to share. We'll answer as many as we can right after this.
Do you ever feel like you're fighting for financial knowledge? Don't let bad advice be a punch in the gut to your retirement. Take advantage of a complimentary, no-cost, no-obligation consultation with a local, trusted financial coach.
Call Ben Fuchs and the team at Fuchs Financial, 800-380-8985. That's 800-380-8985.
Welcome back to the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. Ben is back with us to help you take charge of your money. A little bit about Ben. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years in the retirement planning business. And we want you to get the How to Retire Blueprint, no cost or no obligation. So here we go. Here's that phone number. Jot it down. 800-380-8985. Put it in your phone. This way you'll have it. 800-380-8985. Folks at Fuchs Financial are standing by. Get on their calendar. All right, here we go. Penny in Portland. I'm 55 with $600,000 saved for retirement. Is it possible to retire at 63, claim Social Security, and live off $6,000 a month for the rest of my life? Thanks. Well, I don't know, Ben. What do you think? What do you have from Penny?
Penny, anything is possible. I mean, my first thought is yes, probably. So again, I like to use this phrase a lot. It's scenario-based planning. And so what that means is that we'll take your information. We'll take what you're going to get at 63. We'll look at how the $600,000 is currently managed and what rate of return we expect you to continue getting on that if you leave it as it is now. And then, of course, factor in the amount of taxes that you'll have to pay when you take out your $6,000 a month. And we'll put that into a different program, and we'll see. Here's how you'll get. Or, hey, you could do this, and you'll run out of money at 95. Or you'll run out of money at 85. Or you won't run out of money at all. Great. Or this is how much you'll have left over when you're 100. But we can look at some of those scenarios and figure out how comfortable you are with it. On top of that, keep in mind that $6,000 a month is only in today's dollars. So by the time you're 63, it will be more than $6,000 a month because of inflation. And by the time you're 66, it'll be more than that. And by the time you're 71, it'll be more than that. Because what we find is that not only are people living longer, they're also more active. So as much as we're beating a dead horse here, talking about inflation over and over and over again, we talk about it over and over and over again because people tend to disregard it when they think about their retirement. They think their spending is static, it's not going to change, and it's not. It's going to continue to go up over time, and we want it to because we want to maintain the lifestyle that you have in retirement and make sure that you're comfortable. So my first thought is yes. My second thought is, why don't you come in and let's take a look and figure out how we can do that? And if we can't, you should know that ahead of time so that we can plan accordingly.
Right. Okay. So I'm going to do some math here, Ben. So buckle your seatbelt. So $600,000 she's saved, and she's drawing $6,000 a month. But let's put Social Security aside for a minute. That means she's drawing 1% of that $600,000. Is that right?
That would be more than 1%. That would be over 10%. They were talking about $72,000 a year.
Oh, okay.
On $600,000. So we're taking.
That'd be 10%?
A little more. We're talking like 12. I don't have any calculators in front of me. Full disclosure, you would think that I would just have them laying around within arm's reach. But, if you retired right now and tried to live on that, no. I would say the answer is definitely a no. But one, that $600,000 is going to grow over the next 8 years. At least we hope so. If the market crashes, we don't want it to decline, and that's another conversation. So there are some things that we should look at in terms of that to make sure that we're protecting some of this money and, of course, allowing a lot of it to continue to grow. And then you're going to continue to contribute over the next 8 years. And, the factor that we don't know is how much you're going to get from Social Security. We're looking at $1,500 a month or $3,000 a month. So again, we'll figure that stuff out. But ultimately, again, that's why we say, come on in. Let's bring your information. Let's take a look at how you're invested now. Let's figure out what we can get for that and see how comfortable you'll be in retirement.
All right, before we get to our next question, I do want to remind everybody, get the How to Retire Blueprint. It is 800-380-8985. Folks at Fuchs Financial standing by. Meet with Ben and his team. 800-380-8985. The show is How to Retire with Ben Fuchs. All right, our second question. Glenn in Glastonbury, I'm 60, hope to retire when I'm 62. Would that mean I'll be able to take RMDs at 62 or wait till I'm 72? I looked into the IRS info page, but it confused me more. And how does Social Security factor into this equation? Can I file for benefits at 62 to bridge the gap, if you will? Thanks in advance. What do you think about this?
Glenn, thank you for giving me a few questions to work with, buddy. All right.
Yes, sir.
First thing, not that I'm, into correcting people, but for the sake of a radio audience, the RMD age is now 73. It was at one point 72, and before that it was 70 and a half, but now it's 73. So one thing to keep in mind, you are able to take withdrawals from your IRA account, from your 401k, 457, 403b, you name it, the whole gauntlet. As long as you're over 59 and a half, you can take those withdrawals without penalty, but you'll still be paying taxes. The taxes will be based on all of your other income, including obviously what you take from your IRAs and, Social Security. You are able to withdraw as much as you want to without being penalized on your Social Security. Again, the taxes will change, but there are rules that talk about, retiring before your full retirement age. That only applies to earned income, meaning working at a job. But you can withdraw money from an IRA. It's not earned income. It's investment income, or whatever they want to call it, retirement income. But it's not technically considered earned income. You're not paying FICA taxes on that like you are with, money that wages from an employer. So when we look at that, it's a non-issue. Yes, you have the ability to, whether you should or not. Again, come in, bring in your statements, bring in your tax return, bring in all the stuff that we can use to look at to give you a good, solid free consultation to figure out, what works for you. So claim your spot on our calendar, and let's figure out how we can, help you be comfortable in retirement.
All right. Great question, Glenn. Get a hold of Ben. Give you that phone number in just a minute again. Melvin, Middletown. I'm approaching 75. Would an annuity be a good option for me, given the interest rates right now? Thanks for changing my mind on the matter. Wish I'd considered annuities sooner in my life, but it's worth asking.
All right, Melvin. Look, man, I can't tell you yes or no on the radio. Maybe I would say that typically at 75, I don't want to do what people consider to be the traditional annuity. So a traditional annuity for a lot of people is basically a pension. We get income for the rest of our life. We die, that money disappears. And at 75, sorry, man, I'm not trying to be a jerk here, but we have to factor in life expectancy. I think what's important is figuring out what your goals are. What's the goal of the annuity? Is it to get growth without having to worry about a stock market loss? Okay, there are some options there that we can look at. Is it to generate income so that you can take this at 75 or 76 but still have money if the market declines, or if you pass away? Maybe it's a lesser income amount, but you can still make sure that money goes where you want it to if you're not here or if you pass away early. So those would be reasons to be considering an annuity. For a lot of my clients, it's just a safe growth tool that we use in lieu of CDs. It's an opportunity where the market go up, you make some money, market crashes, you don't lose anything, you keep what you've already earned. That's the goal with these annuities for the majority of my clients. Or maybe it's, hey, I'm 10 or 15 years out and I want to guarantee a certain portion of my income down the road. With that said, there's a lot of different ways to get from A to B. And some people just hate annuities. In some cases, they just don't make sense for people. In a lot of cases, they don't make sense. So our job is to figure that out and discern where it is and is not appropriate for each individual person.
Yeah, and again, it's everybody's an individual. Ben's plan is completely customized to you, not the guy that comes in the office after you, the guy that comes in before you. That's why you need to get the How to Retire Blueprint. It's a comprehensive plan. And here's the good news. There's no cost or no obligation to it, so what are you waiting for? 800-380-8985. Meet with Ben and his team, or his team. Got a great staff of people helping you when you walk through that door. 800-380-8985, the How to Retire Blueprint. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Let's see. We can get one more question in quickly here, Ben. Leon in Litchfield. I lost my job at 61 years old. While I'm worried about retirement still and intend to return to the workforce as soon as possible, I've been lying saying I'm not a bit concerned about this. What do I do with my 401k now that I'm no longer working?
So traditionally what we'll have people do is that we have them roll their 401k from the employer's plan into an IRA, which is really your plan. It's an individual retirement account. And the reason that we do that is to give people more choices, more plans. For you specifically, what we want to do is start generating a monthly income off of some of this money so that we can bridge the gap between what you were making and what you want to be making comfortably without reducing your principal. In situations like yours, we've had clients suddenly, or people that are meeting us for the first time, suddenly lose their jobs. It's, hey, one, we need to protect this money now more than we did before. We're going to start relying on this money earlier than we probably expected to. And in that case, we can make some changes, but those changes are reversible. So if we need to generate income for you for the next 6, 7, 8 months, we can do that. And then you get a new job, we can turn that money off. We can have that reinvested in more growth-oriented accounts. But the goal is to figure out, what makes sense for you, what's going to put you in the best position so that you can retire or go back to work. I've had people lose their job at 61 and go back and work until they're 68, very comfortably, very happy. So, we know these things happen. We unfortunately know that people in that specific age bracket, the 59 to 62s, the people that are preparing for but are not quite ready for retirement, tend to be the people that are in their bracket that, make the most money, that corporations namelessly will say, this is where we need to cut so we can save costs, bring in somebody that's 35, which is tough and difficult, but still a reality. But ultimately, that's why we have our offer. We give you a complimentary consultation. We give you a free meeting. Come on in, meet with a member of our staff. Let's figure out what we can do to help take the burden of retirement money planning off of your shoulders. This is all that we do all day long. We don't go crazy. We don't do a whole bunch of other things. We focus on people who are retiring. They're getting close to retirement. They're 3-5 years away from retirement. They're already retired. They were forced to retire. But we help you figure out when and how you should take money out of your 401k. There is a right and a wrong way to do it. And we want to make sure that you're protected. 2, it's making sure that if the market crashes, we don't lose a big portion of our income. Right? We don't want our monthly paycheck to be determined by the weight of the stock market. So again, insulating you from that, incredibly important. And then taxes. Right? Ultimately, are we as efficient as we can possibly be? Are we doing the right things to get ourselves as prepared for retirement so we can be as tax efficient when we retire? That's all for the How to Retire Blueprint. But we can't help you with any of that unless you give us a call, you pick up the phone, and you schedule an appointment.
All right, Ben. Great advice. Boy, the show has just flown right on by here. Before we wrap up the show, I want to remind everybody to get the How to Retire Blueprint. It's a comprehensive plan, no cost or no obligation. 800-380-8985. Your chance to benefit from a How to Retire Blueprint. Call right now. We still have a limited number of availabilities on our calendar this week. And remember, the consultations are offered no cost or no obligation. Claim your spot on the calendar right now before they go. 800-380-8985. Well, the show has flown right on by. Like I said, I'd like to thank everyone for listening. We hope you found the information we presented helpful and look forward to all of you being back next week. We'll have new topics, new questions right here on How to Retire with Ben Fuchs. Ben, a pleasure as always, my friend, and I look forward to talking to you again next week.
Same with you, Gary. Thank you, sir.
Investment advisory services are offered through Foundations Investment Advisors, LLC, hereafter known as Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment, opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for information informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor situation is different, and ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio of securities, or investment strategy is suitable for any person. No legal or tax advice is provided. Please review your retirement, tax, and legacy planning strategies with a legal or tax professional before transacting or implementing any strategy discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, or any U.S. government agency. If applicable, we do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. All rights reserved.